So first, let's work from the situation that you have your tokens on your Tangem or Ledger or on any other wallet. You should go to deposit, and let's say we want to they have to be, you have to send them back to an exchange. I think you can sell some on Ledger. Ledger has an exchange on it itself, but I think that the swap fees and the rates are less, are a bit worse than if you just send it back to Mexc. So I would always advise to send it back first and then sell it on an exchange. So for example, let's go with RFox. We have RFox on our ledger. Then first you want to deposit it back to Mexc. Well, like this. Then you tap to generate your address. Well, you get this. But don't show again. And confirm. And as you can see, I get an address here. So it says network ERC20, which is the only network because an RFox on. And then you have the address here. So when you then go to your ledger, make sure to copy this address exactly, put it in the ledger, and then send your tokens back to Mexc. Could take a while. As you see here, 64 network confirmations. So after they will arrive back, you will find them under spot. That's where your assets will be listed. So in this case, we only have a little bit of USDT here, but you will find your RedFox once it's back on Mexc. You will find it here. What you then do is you go to the trade tab, and as you can see, it is already on RFox USDT. But if it's not, you press the pair button, and then you search for the right pair. You click it, and then what you can do is, or what you should do is, you should press sell. And then you have two options. You can set a limit sell, which means you are selling at a certain price that you have in mind. So let's say I want to sell at 25 cents. Then you put in a limit order for 25 cents, and here you will see how much RFox you have back on Mexc. So you then either use the slider here to slide how much you want to sell, or you just put in either the quantity of the RFox you want to sell or the total of USDT, how much you want to get for. So if you put in 250 here, you will then see how much RFox you need to sell there for, and if you put in 10,000 here, you'll see how much you get. So that's basically the first option to sell, a limit sell. If you do not really care about the exact price, you can also choose a market sell, and like it said, it places the order at best price. The only thing you then can choose is how much RFox, RedFox in this case, you want to sell. But sometimes you'll see a big spread, which means that if you are selling, in this case, that the sell price, because if you are market selling, you're selling for the best price available, which is the first buy order. And if you're buying at market, you are buying for the first sell order available. And as you can see, there's a bit of a difference between those two prices. So always check, if you want to sell market, if there is a lot of spread or not. So if there is a lot of spread, And on volatile coins that could be, and like Red Fox, there can be quite a bit of spread. What you then can do is best, if you want to sell at market or at best price available, just put on a limit and tick the first price there, and then put in the order. So then your order will get below this. So let's make it 93. So always check on the market what the spread is on a coin. So yeah. Well, I think that depends on what time frame you are charting. As you can see, there is a fair value gap here. Let's zoom in a little, makes it easier for you guys to see. Because every higher time frame fair value gap should always have smaller time frame fair value gaps. But I think, in my opinion, it's best to just stick to the time frame you are charting. Because if I chart on the 15-minute time frame, I'm looking for trades that play out on smaller times, so I'm not looking for a big move up to fill this 4-hour fair value gap. There's a possibility, and maybe we can look at that this top 26,850 did fill a 15-minute fair value gap in here. As you can see, if I zoom in, this is the 4-hour, but as you can see, there is also a small fair value gap here, which was still open. So this is considered filled, and this is still not totally filled, only to the 0.5. So work from the premises that the higher time frame is more reliable, and that for the long run or the long term, that usually FVGs get filled. But if you're charting on the 5-minute time frame, just focus on 5-minute fair value gaps. You could use, like when you're charting on the 15 minutes, you could use a 1-hour fair value gap, in my opinion, to have some sort of area that you know price may go back up to. So if you are in an uptrend, you know that there's a 50-minute fair value gap in a 1-hour fair value gap. There could still be a move just above it to fill the 1-hour fair value gap before it gets back down. So like I say it's best to let it rely on the time frame you're charting. So this is a set of rules I use for the 3-bar reversal pattern setup for the 180 trade challenge. So mapping out lower lows and lower highs on downtrends, or mapping out the uptrend, and we should short only from a lower high, and we should long only from a higher low, except when there's a market structure break. Then we long from the higher low, and we short from the lower high. That's still the same. So these are the rules for the long setup. We have so the set of rules are obvious and are clear. So with that in mind, I then go to the charts. And what I then usually do is I just start scrolling through, and as I tend to look on the 15-minute, I just look for the start of a 3-bar reversal setup. So I would be looking for a bullish candle or a bearish candle, making a higher low or a lower low or a higher high. So I just go through the charts until I find some candles that I think are fitting the strategy. And sometimes it takes long, sometimes it's just every 30 minutes going through this whole list and not finding anything, because the pattern just isn't there. So as you can see, this one, EGLD, it made 2 bullish candles with the bullish candle being a higher high and a higher low from the first candle. So this is the, let's zoom it in, this is the first candle, this is the second candle. And what we then should be looking for the signal candle, which is the candle that should potentially signal an entry, is that it has a lower low than the second bar, and closes, I mean a lower high, sorry, a lower high than the second bar, and it closes below the low of the first bar. But as you can see already, that the high of the third bar is in this case 24.12, and the high of the second bar is also 24.12. So these have equal highs, which means it doesn't fit the rules. So I would leave it for now and just move on. But this is in the case of strict rules, certain pattern. But if I go back to the time when I first started trading, I did start with trend lines, as I like to trade patterns, and I still sometimes do. And what I then did was, just on the higher time frame, mostly the 4-hour, I would just zoom out on the chart and do the same thing, but then looking for trend lines. So I would look at a chart. Let's say I was looking at this one, and I would just draw a trend line that seems obvious to me, not the most clearest one, and then I would be looking for clear structures or patterns in there. So when I started out, I always started from drawing trend lines and then seeing what price was doing based on those. And as you can see here, we have a trend line here with price on the lower trend line. So this then could be possibly on the lower time frames the place for a possible breakdown, retest, continuation down, or it just could reverse here and back up to the top. Later on, I added more support and resistance areas, but I think it's best to just start with one thing and recognize those on the chart and just go through those day after day. Just find the things or the indicators or those things that fits your style best, or the things that like stand out to you from the moment you see a chart, because when you practice that a lot, it becomes easier to spot certain trend lines. It becomes easier to spot certain breakouts and levels that are of interest, and it gets easier over time. But you should just start with one thing and then slowly adding others. If you like to trade patterns, just start with recognizing patterns on charts, drawing those trend lines, like I said, and then at a point where you will add fibs, or you will add fair value gaps. You would be looking at EMAs, resistance and support, and so on and so on. So you usually find liquidity at points where price either rejected or bounced. Because what this wick tells you is that there were at first a lot of sellers. If we go, let's zoom in to this wick here. Every candle tells its own story. So this is a 1 hour candle, a big candle if you look to the candles before it and after it. What this candle tells us is that there was a dump from the start, because as you can see, every candle tells you the open price, close price, the low and the high. And as you can see, if you look close at this candle, we had the close price here, the open price, sorry. So this was open of the candle. This was the high of the candle. This was the close of the candle. And this was the low of the candle. So it tells you a couple of things. It tells you where the price started when the candle opened, and that was in this case fairly on top. Then we had a high, so somewhere in this hour the price moved higher than the opening price, but then it dumped rigorously, and it dumped to its low, but it then came into an area of liquidity. And what does it tell you? Because it came here and then there were a lot of buy orders, buyers stepping in here, and as you can see, it closed somewhere halfway, and then liquidity means nothing more than an area of buying on the low, or an area of selling above, where most traders will put their stop loss. So let's say if you were longing on this in this area after this wick, you would put your stop loss somewhere here, which means that this is the liquidity that has to be taken. It's just another word for either a lot of stop losses being there and also a lot of buying and selling pressure or orders in a certain area. I think there is not a better or worse between the simple moving average or the exponential moving average. The difference is that exponential moving average gives more weight to the latest candles. So what a simple moving average does, if you have a 200 or let's say a 50, that's easier. If you have a 50, simple moving average, it just takes the average of the 50 last candles and adds that up and then divides it by 50, which gives you an average overall. And the exponential moving average just gives more weight to the latest candles. So the closer the candle gets to current price, the more weight it has on the average. So people tend to say that the EMA is a bit more reliable because it moves better with price. So a spike up, you'll see the EMA move quicker up than the simple moving average. But like I said, also there is, in my opinion, not better than the other. It just some people like to use EMA, some like to use the SMA. And I think CB, I think we both use EMAs. So now I'm not saying they're crucial. It's just I use them a lot. Because if you look back on I think any price movement, you will see that the 200 EMA is always a point of either resistance or support. As you can see, it's just from because so many people use it. It's a self-fulfilling prophecy, and it becomes an area of resistance or support. So once it breaks out of or through the 200 EMAs, you'll see it then act as support. That's why I like the 200, because it's a strong indicator. So yeah, I would personally would never leave it out when trading, but you shouldn't be too focused on what anybody else is doing, or you should be focused on your own strategy, because I think I talked about this a lot in other videos too, and live streams. The more how do you say it, the more info you want to gather, the more indicators you want to look at, the more hesitant you become on putting out trades, because 5 people can look at this chart and 5 people can have different trade ideas, and there just isn't one way to trade. There isn't just one way to make money trading, and that's why it's so important to stick to your own strategy, make your rules, write them down and stick to them until it works or it doesn't. But it has to take, you have to take time. That's the same with the new strategy for the 180 trade challenge we did last week. 3 trades, 2 cancelled, 1 went to stop loss. The one we cancelled did fail and eventually went to 4R. But those type of things happen. It doesn't mean it doesn't work because we did 3 trades and we're still in the minus. No, you have to take 50 trades or maybe 100 trades to see if it really works and that you have an edge over the market. So like with the 180 trade challenge, I took that new strategy on and I tested it for a week, and that was a good week. But it doesn't say every week is a good week. So that's with your own strategy too. If you have 5 losses in a row, or if you take 10 trades and you have 4 losses, it doesn't mean the strategy doesn't work, because nobody has a 100% hit rate. You can't have a 100% win rate, never, because market can do anything at any time. So even if everything lines up perfectly, you have a golden pocket and you have an FVG filled and you have bearish movement and a reversal signal, etc., etc. Market can still go the opposite way. So that you have to take that into consideration when trading. And like I always give the example of flipping a coin. Flipping a coin is a 50-50 chance of flipping heads or either tails. But if you flip a coin 10 times, it doesn't necessarily mean you flip 5 heads and 5 tails. You can flip 8 heads and 2 tails. But the more you flip, the closer you will get to that 50%. So that's also with your trades. The more trades you take with exactly the same rules, with exactly the same risk, and exactly the same take profit management, the more you get to the point what it actually means in terms of profitability, having an edge over the market. You can't say after taking 10 trades on the same strategy that it works or it doesn't, because maybe market is shit at the moment and you just have those 10 trades being just that that set of trades that wasn't profitable. But if you take 50 of them, you come more and more closer to the edge it really has. So that's why I say you shouldn't be too soon with tweaking a strategy or too soon with changing a strategy. Make sure you journal everything. That's what I keep telling everybody. Journal everything. Journal every trade you take. And it's easier to journal if you stick to your rules exactly, but also journal what it does to you as a person, what it does with your emotions. Because sometimes you want to take profits early, but when taking profits early, it means your risk reward isn't that good. Let's say if you take profits too early and on every trade you only take 0.25 R, which means if I'm risking 10, let's say I'm risking $10, I just take $2.50 on every win. It means I can only have 1 loss for every 4 wins to break even. So you want to look at that risk-reward ratio when trading, and you don't want your stop loss be too tight, but you want your risk to be also at least 1 R when taking profit. So it's always looking for balance between when to take profits, because market is unpredictable, but also how to take profits without becoming a losing strategy. I read a book, Best Loser Wins. Great book if you ever want to read about trading and how to think about taking profits and how to trade profitable. And in that book, there was research done amongst, I think, 25,000 traders, putting out millions of trades, and 90% of them weren't profitable at all. There's a reason we always say that 90% of the traders don't make it. But it wasn't because they were all, they didn't have winning trades. What stood out was that the winners were always smaller than the losses. So it's something human nature does to us, that when a trade goes into the red, we either add a bit or we think, well, let's see where it ends up, because I see things on the chart, maybe it'll go and turn into my favor. And that's why you have invalidation levels, because if your stop loss is always 1R, let's say your stop loss is always $10, but on, like I said, on every trade you take, you only make $2.50, but you let every trade run to stop loss. You can never become profitable unless you are 90% or 100% winners, because even one loss will make you 1 to 4. You would have a win rate of 80% to break even. So it's a good thing to think about when you're putting out trades. Okay, what's my risk, and when do I take enough from that trade to be profitable in the long run? So I can take one loss, or maybe even two losses, that you then, if you take two losses, you only need one win to clear those losses. And that's a strategy like the 180 trade challenge was a 1-to-2 ratio. So for every loss I had to, for every two losses I could win one, but I had to go to take profit to make back those two losses. And I changed that to a more tight stop loss, but a bigger R for reward. So the aim is to have at least 2R on every trade. But that's what a lot of people don't realize, because I talked about that last week. Like when you have an open position on Mexc, you can look at the percentage of the trade and say, well, whenever it's 10%, I take my chances and close a trade. But the 10% isn't 10% of your balance. Could be, for all I know, it could be just 0.1%. So you always have to look at the margin. And RR is way better to look at it than just percentages on a trade, because if you do 20 leverage, it's easy to go to 10-20% on a trade, but it doesn't mean you win 20% on your balance. So the only way, or the only thing why leverage matters is possible fees, or it gives you more weight on the trade with putting less margin on, but it doesn't matter for your risk if your risk is in check. So here's an example of a trade with two entries, both 50% on each entry. This is 7-time leverage, but let's say I put on 11. Potential loss stays the same. It's still 3% of that 500, which is $15, but the margin changes. So the lower the margin, the more. If I put it on 1, you'll see that I have to put more margin on. And the higher I go, the less I have to put on. But the win and the loss just stays the same. So the only reason to use high leverage, that's what people don't always understand. There is no need for high leverage unless you're trading a coin that hasn't much percentage moves like Bitcoin. Bitcoin doesn't move much percentage wise, so that's why you use high leverage on Bitcoin, because Bitcoin doesn't move 1% easy or 5%. So then you need higher leverage to make profits from that move. Or you should have very high margin. But on lower cap coins, on coins that move more percentages in a day, you don't need high leverage. It only looks nice if you can see, well, I made 50% returns. Yeah, but you only made 50% returns on your margin. 50% returns on 50 leverage is the same as 1% return on 1 leverage. So yeah, you know, it's just a game of it's a mindset thing, because people like to use high leverage because it shows you those big gains. But if you dig down deeper and you look at the margins, it's the same. And that's exactly, if you only use 10 times leverage, that's okay, because leverage doesn't matter. What matters is the risk. What matters is the margin you put on. If you don't change your margin and you put on 50 leverage 50 times, and you don't adjust your margin, well, then you're either stupid or very lucky if it goes your way, because then it affects the risk. But as long as you're working from the risk, as long as on every trade you make sure you're only risking like 1% or max 3%, and you then you can even do 25%, 25 leverage or 20 leverage. That doesn't matter, but it makes it sometimes harder to just look at the risk reward ratio, because if I'm on 20x leverage, what people tend to forget is this. As you look at the box here, you can see that if my stop loss hits on this trade for my first entry, it would mean I have a loss of 70% of my margin. And when take profit hits, it means I'm taking 133% of my margin. But what happens is I'm entering the trade, and then I'm looking at my P&L section, and my P&L says plus 25%, and I get excited because I'm making 25% on this trade, and I think, well, maybe I should skim some profits, or maybe I should put stop loss to entry. But what you don't think about, or what people tend to forget, is that that's actually just 0.3 R of your on your trade. So let's say at 25% you're very happy with your profits and you close your trade, but on the next trade it's the same and you lose. You have to win 2 other trades to only make up for that loss. So I think that's what we try to tell from the beginning, that people get in here, that you have to look at risk and reward ratio, and you have to look at the risk you put on trades, and it doesn't leverage doesn't affect it unless you play with higher margin. But if you do that, it becomes gambling instead of just trading with risk in check. So and yeah, of course it looks way nicer when that button begins to flash on Mexc, giving you more than 50%. How do you say, more than 50% P&L, but in the end, the potential win, if you have 500, you can put on $10 of that 500, or you just can take it easy and only put on 5x, put a little bit more on, and then you see the only thing that changes is the percentages. The percentages change, but the potential win or loss in dollars doesn't change. So that's something to keep in mind. And that's why I think it's best for people that are new to really focus on that risk they're taking and the reward they're getting from a winning trade. I never change RSI, just keep it as it is. So let's see. Just 14, and I think simple moving average 14 to, I think, standard settings. I think these are the defaults. Yeah. So I never change it, so I just changed it. So just keep it at 14 and MA length also. That's just a standard intervals. We're here to help you guys. Have questions, always make sure to ask, either if we're live or in beginners chat or in one of the discussion rooms. Don't hesitate. We can only learn by asking questions and learning from them. So yeah, you're welcome, guys. Then I'll go and wrap it up. Wishing you guys a nice day, and hope talk to you again soon.